Most people spend decades working for money without realizing a tiny weekly habit can quietly replace their salary. If you ever wondered why your paycheck never seems to stretch as far as expected, there's a deeper mechanism behind it. The same force that erodes your earnings is the force that can multiply your investments. Once that relationship clicks, your entire financial picture stops feeling random and starts feeling logical. Today, we're going to unpack what's really happening beneath your income, why consistency beats intensity, and how steady investing changes the direction of your future finances. We'll examine rising costs, the mathematics of compounding, and a simple diversified index strategy that can grow into a portfolio capable of generating thousands monthly. But before strategy, we need clarity. Why does a small recurring deposit often outperform occasional large deposits in real life? Most people dismiss small investments because the amount appears insignificant. $10 or $20 seems powerless. Yet, the hesitation usually comes from everyday financial pressure. When expenses rise faster than earnings, the size of the deposit matters less than the repetition. Think about groceries. Over the last few years, prices gradually climbed year after year. Items you casually bought for a certain price now cost noticeably more. You don't need charts to understand it. You feel it at checkout. Meanwhile, borrowing became heavier. Loans, credit cards, and financing costs rose steadily. Payments that once felt manageable slowly started squeezing budgets. Wages, however, increased modestly. Raises arrived, but they mostly kept you in place rather than pushing you forward. Why does progress feel stuck even when income rises? Because income moves in straight lines. Compounding moves in curves. Salaries grow by effort. Wealth grows by time. Markets reinforce this idea. History shows repeated crashes, economic downturns, recessions, sudden shocks. Each felt catastrophic in the moment. Yet the long trend continued upward afterward. Over long periods, diversified equities historically returned significantly more than wage growth. That difference is the entire story. A weekly investment habit removes prediction from the equation. If prices climb, you keep investing. If prices fall, you buy more shares. If recovery follows, you benefit automatically. You no longer need perfect timing. In a constantly changing world, a fixed routine becomes a rare advantage. Here's the key connection. When earnings grow slowly, but assets grow faster, eventually the assets begin to rival the paycheck. Not overnight, not quickly, but inevitably with enough time. And here's what most people underestimate. Small amounts appear trivial at the beginning. Imagine $20 each week. After the first year, the progress feels minor. Nothing exciting yet, but the foundation exists. By year 3, reinvested returns add noticeable extra value. By year 5, growth starts assisting new deposits. Your money begins helping your money. Why do people quit early? Because the early phase looks unimpressive. Humans expect quick feedback. When results look slow, the brain concludes the system failed. Market volatility amplifies that reaction. Headlines warn of downturns. Temporary declines feel dangerous, but compounding doesn't behave like a straight staircase, it behaves like a rising wave. Would you abandon a plan simply because the first months looked quiet? The real shift occurs when the weekly question changes from, "Is this big enough?" to, "Did I stay consistent?" Control replaces anxiety. Routine replaces prediction. Over time, persistence allows the portfolio to expand beyond earned income, not because of genius decisions, but because of patience. Once mindset stabilizes, choosing investments becomes simpler. Instead of hunting perfect stocks, focus on characteristics that historically support long-term growth. The first is diversification. Owning hundreds of companies prevents any single failure from destroying progress. The second is exposure balance. Different sectors lead at different times, so spreading across industries stabilizes performance. The third is proven fundamentals. Businesses with steady earnings rather than hype. The fourth is dividend expansion, where payouts rise and purchase more shares automatically. And finally, low fees, because tiny percentages compound into large losses over decades if ignored. Combine those principles and you create a resilient portfolio capable of weathering downturns while capturing growth. Now let's illustrate a simple 5-fund allocation model designed around those qualities. The first fund tracks the total market. It represents ownership across large, medium, and small companies in every major sector. Its purpose is broad participation in economic expansion with minimal cost. This serves as the foundation layer. The second focuses on medium-sized firms. These businesses are established yet still expanding, offering stronger growth potential than giant corporations. They add momentum to the portfolio. The third includes forward-looking companies emphasizing long-term sustainability and innovation, bringing exposure to industries shaping the future. The fourth blends stable dividend payers with reliable growers, balancing income and appreciation. The fifth emphasizes companies known for consistently increasing distributions, strengthening cash flow reliability during weaker markets. Together, these layers produce balance, growth, stability, and income simultaneously. To estimate the combined dividend yield, you average the yields of each component. Summing them and dividing by the number of funds produces a blended yield slightly above 2%. Apply the same process to dividend growth and price appreciation, and you see a portfolio that increases both value and income over time. Now, let's make this practical. Imagine an individual investing $5 daily, roughly 35 weekly. It feels almost meaningless, but repetition changes everything. After the first year, contributions establish a base. After 10 years, reinvestment momentum becomes visible. After 20 years, the account can reach 6 figures and produce meaningful yearly income. The final decade is transformative. Compounding accelerates because growth applies to a larger base. Eventually, the portfolio approaches 7 figures and monthly distributions rival a traditional salary. What matters is not the amount invested at once, but the length of time invested consistently. Here's the striking part. Over 30 years, the investor contributes only a small fraction of the final balance. The majority comes from reinvested returns and market growth, not personal deposits. Wealth is rarely built by deposits. It's built by duration. At that point, the portfolio, not the employer, becomes the primary income source, all originating from a routine small enough to ignore. Isn't it strange that consistency outperforms intensity financially? If you stay disciplined long enough, your investments can eventually out-earn your labor. And once you see that possibility, saving stops feeling restrictive and starts feeling strategic. If this changed how you view money, press like and subscribe to Profity Mind so you don't miss the next breakdown. And if you could only choose one long-term investment, what would you pick?